Let's talk about the future of investing. And I want to start with this point. Whenever I talk about Nuveen, I don't think enough people realize that you are the #1 investor in farmland worldwide.
Yeah, I'd say natural resources in general, but farmland, we are by far the largest investor in it. And it's a conviction we took. We built that platform well over 10 years ago. Today, we're almost approximately 20 billion in AUM in that space. And it was one built for today's times, actually. It was one that we said, hey, inflation may show up someday. You may want less volatility in your portfolio. You may want more yield. And here we are today. We always say the hockey pucks come to us.
It's arrived. So let's talk about it a little bit more. The 60-40, things have changed a lot. Can you help me understand what the future of investing looks like? And perhaps we can reflect on something I talked about on a panel a little bit earlier this morning. You were in the room. Hugh Van Steenis, formerly of Morgan Stanley, wrote a fantastic piece in the Financial Times in the last few months. Originally, many years ago, he forecast that ultimately investing and investor flows would polarize into this ultimate barbell. And on the one side, it would be super passive, exchange-traded funds, cheap, convenient access to benchmark returns. On the other side, you'd have flows into specialized managers, alts, private markets, et cetera, et cetera. Have we arrived? Is that process complete, or is it changing?
I think it's always changing, but I think that's been going on for a while. And it made sense at the time. We've been going back to even 3-4 years ago, we were saying something that people understood academically. Again, you're going to have more volatility going forward. Returns are likely going to be lower in the next decade. And who knows, inflation may show up, and are you protected against it? And yield's going to be important. That, while people understood the academics of it, wasn't really an urgency. In a world where markets are doing this, you can kind of go out and say, I'm going to invest passively. And then, on the side, I'm going to look for these opportunistic exposures and just exposure on the alternative side. Today, that is more of an urgency. So you're seeing more and more creativity around solutions, products, innovation to try to get Main Street investors more access to alternatives to truly be more diversified.
What's the catch with financial creativity? Because when you say financial creativity, some people are saying, okay, so when are we going to actually see whether there are underwriting standards that are going down or there's some sort of pitfalls within these private markets that are less transparent and being replicated everywhere for higher fees?
Sure. Look, the catch is liquidity, right? That's what always is. Again, people getting their capital locked up versus I can get it very cheaply in a very liquid way in an ETF, which is still a very viable vehicle. Yet, what is the value or the premium put on liquidity versus 10 years ago versus today? That additional return and alpha you get for taking your liquidity is very, very valuable today. So that's been the catch, but the perception of the risk behind liquidity or illiquidity, I think, has changed as well.
But how concerned are you? We think about sticky money, and we did see that real estate crisis, I should say, in the UK, within the past 2 years or so with respect to outflows and what happened with forced selling. We haven't really seen that forced selling yet for some of these funds that do cater to individuals. Are you worried about that at any point, that we are going to see that sort of pressure, that realization of losses that we haven't seen in certain private markets?
I really don't, because today what you've seen is the sophistication of investing in private markets and who's invested in private markets today, where it's very well balanced. Real estate, people love talking about real estate, and it's really around the issue that you're seeing in office. If you look at REITs today, 3% of their exposure is to office. The average institutional investor has maybe 10 to 15% exposure to office. They'll feel some pain there, but you know what? Things like life sciences, storage, logistics, they're doing fine. So again, it's an area of the sector where people are a lot more diversified than you would think, and the liquidity is going to be felt, or the lack of liquidity is going to be felt differently. The
ultimate question, I think, that leads to questions like these is, have we really paid the price for taking interest rates to 5.5% from zero? Do you think we have?
I don't know the answer to that. I will tell you that more and more, we've been on the camp of a soft landing, going into 2024. More and more, I think that seems more likely the case. When I went to school, the idea of the Fed taking up rates this much and being where we are would have been unheard of. But we are in different times, that's for sure. I am a believer that we are going into a soft landing. I think that there's a lot of cash on the sidelines today that even at these rates is going to come back into the system as well. But the uncertainty will be present there for the rest of my career, right? The idea that whether it's a geopolitical issue, whether it's a policy mistake, the risk of this thing going the wrong way is there and will continue to be there into the foreseeable future.
So you caught the end of the panel that I did this morning on peak private markets, and I think at the very end I tried to introduce politics. You saw the reaction to the participants when I tried to talk about President Donald Trump returning as President Donald Trump. How are you thinking about elections in 2024? How meaningful are they to you?
Yeah, I take lessons from the previous elections, and I will tell you, I've been through many different cycles of Brexit discussions, the Trump election, the first time around. We all looked around and thought about putting in hedges what we would do differently. At the end of the day, we took a step back. I can't control elections. I can't control the markets per se. We can control the fundamentals and how we pick good management teams, good companies. So I've learned to kind of move away from that noise and really focus on the fundamentals of what we do well and anticipate volatility.
When you talk about politics, I have to also bring up China. Xi Jinping has sent the biggest coalition from China to Davos since 2017. A lot of investors are still saying it is an uninvestable nation. Where do you stand on that?
Well, they've been a big part of the global economy for some time. And yes, they are not open to global investments from the international community as, for example, investing in Switzerland or Germany for that matter. But I will tell you, they are still an important part of the globalized economy. People talk about globalization also around, we're going the opposite way. No, we're not. The pendulum's swaying a little too far. People are understanding the issues with value chains. It takes decades to change them. So I still think China's going to be a big part of the equation, albeit people have learned some lessons and are going to be a little careful in terms of how they interact or make investments around that. We started a policy some years back, let's go long with China short and let's do it in places like Australia. You could do that for some time. I'm not too sure. I think the world will continue to globalize.